If you've ever tried learning about investing, you've probably heard terms like index funds, mutual funds, ETFs, and hedge funds. At first, they all sound almost identical. They all invest money, they all own stocks, and they all promise to help people grow their wealth. So, what's the difference? More importantly, which one should a beginner actually choose? Today, we're breaking down these four investment types. Part 1, what is an index fund? Imagine you want to own the biggest companies in America: Apple, Microsoft, Amazon, Google, Nvidia, instead of buying every company one by one. You buy a single investment that already owns tiny pieces of all of them. That's exactly what an index fund does. It simply follows a market index. The S&P 500 index tracks the 500 largest companies. No one is trying to guess which stock will be the next winner because there's very little buying and selling. Imagine the stock market is like a football league. Instead of betting on one team, you buy the entire league. Some teams lose, some teams win, but over time, the whole league tends to grow. Pros and cons. Many of the world's greatest investors recommend index funds for beginners. Part 2. What is a mutual fund? Now let's talk about mutual funds. A mutual fund is also a collection of many investments, but here's the difference. Instead of following an index, a professional fund manager chooses what to buy and sell. Their goal is simple: beat the market. Every day, the manager researches companies. Think of it like hiring a professional chef. Sometimes the chef prepares an amazing meal. Sometimes, not so much. The same thing happens with mutual funds. Mutual funds usually charge higher fees. Higher fees mean lower profits. Advantages. Disadvantages for most beginners. Paying higher fees isn't always worth it. Part 3, what is an ETF? Next, let's talk about ETFs. ETF stands for Exchange Traded Fund. An ETF is very similar to an index fund. In fact, many ETFs are index funds. The biggest difference isn't what they own, it's how you buy them. Index funds are usually purchased directly through investment companies. ETFs trade on the stock market just like regular stocks. That means you can buy or sell an ETF anytime during market hours. Imagine going to a supermarket. An index fund is like ordering groceries online. An ETF is like shopping inside the store. ETFs are popular because they offer. Many investors prefer ETFs because they're simple and convenient. Whether you're investing $50 or $50,000, ETFs make it easy. Part 4, what is a hedge fund? Now, let's move to the most mysterious one: hedge funds. Unlike index funds, mutual funds, and ETFs, hedge funds aren't designed for everyday investors. They're usually available only to wealthy individuals and large institutions. Because hedge funds often use advanced investment strategies. They may borrow money, use leverage, trade options, short stocks, invest in private companies, or even bet against the market. The goal isn't just steady growth. The goal is maximum returns. Higher potential rewards usually come with higher risk. Some hedge funds make billions, others lose billions. Many hedge funds charge something called 2 and 20. Those fees are much higher than index funds or ETFs. Imagine driving a Formula One race car. It can go incredibly fast, but it's much harder to control. That's a hedge fund, not built for beginners. So let's compare everything. Index fund, low fees, passive investing, perfect for long-term beginners. Mutual fund, professionally managed, higher fees, attempts to beat the market. ETF, low fees, flexible trading, very beginner-friendly. Hedge fund, high risk, high fees, complex strategies, mostly for wealthy investors. Each investment has a different purpose. The best choice depends on your goals, not someone else's. Here's the truth: you don't need to invest in everything. Most successful investors build wealth by keeping things simple. Invest consistently, stay patient, ignore the daily market noise, and let time do the hard work. Because investing isn't about getting rich overnight. It's about giving your money the chance to grow for years. If you enjoyed this video, thanks for watching, and I'll see you in the next video.